So, look, I think we're in a volatile market and we'll continue to be in a volatile market. It's not just about Hong Kong.
Yeah.
It's about the fact that we're in the later innings of an economic cycle. It's the fact that we have a trade war, trade skirmish, whatever you want to call it, going on. And finally, we're in a political cycle, right? An election cycle. All that, with geopolitical risks thrown on top, creates volatility. Now, our message to clients is stay invested, because equities are still very attractively priced, but be prudent in how you approach equities.
You run an equity dividend fund.
I do, yes.
What's the yield on the fund, and have you seen much more interest and flows into it in the last 6 months, the last 6 weeks even, as yields have fallen?
We have. So our equity dividend fund, the Blackrock equity dividend fund, has a current yield of about 2.7%. Now think about that in the context of where interest rates are, right? The 10-year Treasury, about 1.7%. That's a significant yield premium. In fact, we're at a really anomalous point in time where you can actually get more income from stocks than from bonds.
A lot of people talk about REITs, about utilities, the obvious sort of sectors with a yield. Are those the ones you're putting money to work in, or are there others out there that people perhaps sometimes look past?
Yeah, so we're much more focused on the growth in income as opposed to the current yield. Our current yield is certainly competitive, but we really focus on companies that can grow their dividends over the course of the cycle. And so we're actually underweight some of the more traditional bond proxy sectors like REITs, utilities, et cetera, because I actually think there's risk in those sectors, right? They've been bid up in this low interest rate environment to very high levels. And to me, the high valuations there, that's a risk.
But don't you also have risk in the companies that you target that can grow their yields? Because part of that's dependent upon how the underlying business does.
Yes, you absolutely have to focus on the underlying business, and we look for companies with really positive risk-reward skews, where there's a lot more upside than downside, and so we think about things like underappreciated quality and underappreciated dividend growth. That's the key to success, and you can judge that by the upside-downside capture ratio.
So something like defense companies then, defense primes, would that be attractive?
They are. They're a very attractive sector. They grow with the economy, with GDP. We're in a period of heightened geopolitics, and I think they can grow their dividends over time, and their valuations are pretty modest. They're trading at lower multiples than the market.
Steve, back to the broader markets and the turnaround we've seen intraday today. Do you not see that as a signal that the president isn't going to let the trade issue itself get markets more than 5-6% from their highs?
I don't know what his mood's going to be tomorrow. So, what happened today should not give you any greater confidence in the market. It should continue the narrative of the uncertainty, and think about how that decision was made to put the 10% tariffs on. We knew Christmas was still coming up in December, right? And now all of a sudden we're going back and saying, wait, we've got Christmas, I'll give them some relief. So that was a knee-jerk reaction. If anything, you're a CEO saying, I can't deploy CapEx in this market. This just, doubles down on the uncertainty that you're facing. And as a steward of your company's capital for shareholders, it's almost irresponsible to go out with full spending plans. So tomorrow, it may be another story. The market could be down 400, could be down 500. So I think part of the market selling off right now is people are recognizing that could be the case.